Hey everybody, this is your favorite tax time guy, Alexi Kaplan, CPA from A. Kaplan CPA PC, where your financial freedom matters. Today, on October 15th, 2020, marks the final deadline of this never-ending tax season for this year of pandemic. I've been asked by so many of my clients to go over the proposed tax changes of the tax plans in the event that Joe Biden actually becomes the president of the United States. I've done extensive research and decided to do this brief presentation of what we know so far about his proposals, comparing it to the existing law that came into effect on December 27th of 2017 as a result of the Tax Cuts and Jobs Act, passed and signed into law by President Trump. So a little bit about me. For those of you that do not know me, I am a certified public accountant, certified tax coach, certified tax planner, and a certified tax strategist at my own firm of A. Kaplan CPA. The information is below. I happen to know quite a bit about the taxes and because of my credentials, and would like to share some of my insights of what I was able to dig up in terms of what we can expect from the possible tax plans that Mr. Joe Biden, the Vice President Joe Biden, is proposing. So without further ado, let's jump right into it. Well, some of the things that we know so far is that, as Chief Justice William Rehnquist once said, there's nothing wrong with the strategy to avoid the payment of taxes. The Internal Revenue Code does not prevent that. And the reason why I'm mentioning it is because taxes are complicated, and some of you may have seen the tax returns that were released by New York Times from that Mr. Trump, President Trump, actually filed, paying only $750 in taxes. Meanwhile, he's making millions of dollars every single year. And the reason why is just like Albert Einstein once stated, is that the hardest thing in the world to understand is income taxes. And keep in mind, he was a modern genius of the modern times of the 20th century, and even he could not understand how taxes work. So just to recap, what we'll cover today is the tax issues as they pertain to the comparison of the Trump and Biden tax plans, and they will include the top individual tax rates, small business qualified business income, deductions, capital gains tax rates, itemized deductions, social security taxes, estate taxes, and corporate taxes. And we'll go into details on each one of these topics to kind of let you know what to expect under the Biden administration. So the first tax issue is the top individual tax rate. As it stands today, the top individual tax rate is 37%. It was decreased from 39.6% under the Tax Cuts and Jobs Act, and Mr. Joe Biden would like to reinstate it back to the highest tax rate of 39.6%. The people that will primarily be affected by this are the top 1% of the population making over $400,000 a year. And that's essentially it for that. He wants to increase the top individual tax rate. One of the biggest things that Vice President Biden would like to eliminate is small business tax rate, special small business tax rate, which is a part of the qualified business income deduction that provides for additional 20% of reduction or deduction on the individual tax return for anyone who has a pass-through business, whether you're a sole proprietor, making a net profit, you're getting 20% deduction off that profit and you're not paying taxes on, or if you are a partner in a partnership, or if you are shareholder in the S Corp. Essentially on any pass-through income that's reported on your tax return, Vice President Biden wants to completely eliminate the QBI deduction, and as a result, increasing your overall tax burden. Capital gains taxes. Now, this one is interesting because Vice President Biden wants to not only eliminate capital gains rates at the current of what it is 20% under the President Trump administration, but to actually tax it as ordinary income with the highest rate of 39.6% on anyone who is wealthy. Now, besides that, there's also net investment income tax of 3.8% for anyone that actually pays a 20% top rate of capital gains taxes. So in total, it could go up from 23.8% to essentially 39.6 plus 3.8%. So as you could imagine, the difference will be huge and will affect a lot of people that are sitting on stock and they want to cash in. And at current rates, they'll only pay maximum of 23.8% compared to over 40% that will essentially put a big dent in their pocket. And that's the area that will probably affect a lot of folks. Itemized deductions. Under the Tax Cuts and Jobs Act, President Trump has decided to, first of all, reduce the amount of taxpayers that actually pay or itemized deductions on their tax return, Schedule A, that is. And the main reason was the way he did it is he increased the standard deductions. One of the things he did do is he eliminated completely the PEAS limitations, meaning that people that earn over $250,000 per year, which is essentially middle class, were not able to deduct all of their itemized deductions, and they were limited to deducting only a part of it, called PEAS limitations in a nutshell. Joe Biden would like to reinstate them and essentially have the people capped at what they could deduct if they decide to itemize. Estate tax. Now, this one is the big issue because right now, anyone who inherits a property and essentially from their parents. So as an example, your parents passed away, they left you a house, their basis in the property were $100,000 when they purchased it. Now it's worth $1 million. On the date of death of your parents, you inherit it and you get what's known as a step-up basis, meaning that your value of the property that you inherited is $1 million. And if you decide to sell it, you will not pay any taxes on that $1 million, and you will only pay taxes on the difference if you sold it for $1.1 million. So on only $100,000, you are to pay the capital gains taxes, taxed at the long-term rates of up to 20%. Under the Biden proposal, he wants to completely get rid of it, meaning that in the same example, you would have to pay capital gains taxes on the full $900,000 of appreciation, $1 million minus the $100,000 of original basis, and as a result, tax it at ordinary income tax rates at 39.8%. As you could see, we're looking at paying no income taxes under current law to paying $400,000, over $400,000 in income taxes, if in fact Joe Biden gets elected and the new proposed tax plan will pass. So that this issue will definitely affect, well, majority of the population, because this is something that we're used to. The step-up basis has been used a lot for tax planning. It has been used a lot for by the attorneys advising clients regarding the estate and tax planning. So a lot of you folks will be affected by this change if it was to pass. Social Security taxes on wages. As it stands today, the maximum that you're paying in Social Security is 12.4%, or actually it's 6.2% you are paying on all the wages that you earn up to $137,700 of your taxable wages you're paying the Social Security taxes on. You pay 6.2% and your employer is paying 6.2%. The total is 12.4%. What Joe Biden is proposing is he wants to increase that threshold for anyone who's earning over $400,000 in wages. So most people will pay the taxes, and he's very vague about this based on everything that he's released. Most people are paying taxes on $137,700 and nothing on top of it. But now if you're earning, let's say, $500,000, you also pay additional 6.2 or 12.4%, the full 12.4% on the difference between $400,000 and $500,000, which is additional $100,000 and additional 12.4 $1,000 out of your pocket. Once again, this area could affect a lot of folks. He's very ambiguous in terms of how it's actually going to be prorated and taxed, but it's also there. Corporate minimum tax. As it stands today, after the Tax Cuts and Jobs Act, the maximum corporate income tax that the corporations are paying, and I'm talking about the C corporations, is 21% flat tax on any of their profits. Joe Biden is proposing to increase that to 28%. In addition to this, under the Tax Cuts and Jobs Act, there was an alternative minimum tax that was completely removed, and corporations are no longer paying it, which constituted an additional 15% on any book revenue or book income based on their books and records if it exceeded $100 million. So if you're looking at the Fortune 500 companies, the reason why a lot of companies actually came back from overseas is because AMT tax was completely eliminated. And as a result, they were able to save 15% from their income. And they could then pass it along to their employees and to the shareholders. Now, if this gets reinstated, the likelihood of more companies coming back to US is slim to none. And the likelihood of a lot more US companies leaving is pretty big. Now, comparison of the tax of the actual plan and the key takeaways. I am trying to rush through this because I know these things are pretty boring, and I'd like to make it as fun as possible. So I'd like to, the reason I'm doing it as fast as I can, for you to just get the basic understanding of what's to come. So the key takeaways are very simple. They are: individual tax rates will increase, Social Security and payroll taxes will certainly increase, qualified business income deduction will be eliminated, and this will affect a lot of small business owners with pass-through entities. Itemized deductions will be capped due to PEAS limitations, and corporate tax rates will certainly increase. And the likely outcome of what's going to happen if it actually becomes the law is there will be a lot less economic growth due to additional taxes. There'll be less motivation to earn more income because you'll pay more taxes. There'll be less motivation to keep your business in the United States because of the additional restrictions and taxes that Biden administration will likely to assess as a result of the alternative minimum tax coming back. There'll be less motivation to work because the more you work, the more you earn, the more you're paying taxes, and there'll be less motivation to be your own boss. There'll be a lot less people that will be willing to open up their own businesses, to become entrepreneurs, because QBI deduction will be leaving us, and as a result, it will be a lot less favorable for people to take the leap of faith and start their own business, which unfortunately our economy is depending on, because 80 to 85% of the gross domestic product is brought in by small business owners, not the Fortune 500 companies. Now, what do you need to do right now? It's very simple. I love the word proactive. And proactive, just in case you didn't know, it's an adjective, it's a description of a person, policy, or action, creating or controlling a situation by causing something to happen rather than responding to it after it has happened. So why am I mentioning it? Because there are certain keys to cutting tax, okay? There are certain strategies to cutting tax. Under current law, okay, there are 4 different areas. There's a timing-based strategies, like using 401k plan deferrals to shift today's tax bill to tomorrow. There's income shifting strategies to move taxable income to lower bracket taxpayers like your children. There's code-based strategies like Section 105B that will let you deduct your family's medical bills as a business expense. And there's a product-based strategies like separate managed accounts and insurance type of strategies. So you'll find that the most new law changes will fall under the code-based strategies to make it a statute and completely transforming the way that the tax system works. Now, as a reminder, Tax Cuts and Jobs Act that was passed under the Trump administration at the end of 2017 was the biggest tax overhaul since 1986. So if Biden gets in and he'll get ready to cut or reduce or remove or eliminate or raise more taxes for average Joes like you and I, it'll be the second biggest tax overhaul since 2017. Now, where do you go from here? Okay, I am a tax strategist. I work with small business owners and I help them reduce their tax liabilities only using IRS approved and court tested tax reduction strategies. So how does that work? The process works like going to a doctor. If you're sick, the doctor starts with a diagnosis. What's causing your pain? Then he or she prescribes a solution. Maybe it's a prescription, maybe it's a surgery, maybe it's a physical therapy. Finally, someone fills that prescription, and that's where I come in, right? So we work the same way. We start by sitting down with you for a free tax analysis, where the review of you, we actually review your prior tax returns to find out the mistakes and possible missed opportunities that may have costed you thousands of dollars in taxes. Then we prescribe the solution to stop that bleeding. Maybe it means restructuring your business entity or implementing a medical expense reimbursement plan, like I mentioned before, or rescuing lost depreciation deductions in your real estate. Finally, we'll fill those prescriptions. In some cases, we'll do it ourselves. In others, we'll bring in a network or specialists that we work with, like performing cost segregation studies, or doing the captive insurance management, or charitable trust administration. And at the end, we'll tell you exactly how much money we could actually save you by using our analysis. And as a result, you'll be in a position to save a lot of money in taxes. Okay, that's one of the ways to do it, and that's probably the most efficient way to do it. Now, one thing that I'd like to say is this. Both policies that we actually discussed today will need to have an approval by the House of Representatives and then the Senate, and then finally signed into law by whoever the president is. And let's keep this in mind that depending on who wins the election, those are the people are not necessarily, I'm talking about the party lines, will be controlling the House of Representatives and the Senate. And some of these proposed policies that were proposed by the Biden administration will probably change. And it will take some time for them to become the law. And we will have to follow them, just like we did when the Trump administration decided to pass the Tax Cuts and Jobs Act, and it was signed into law. But at the end of the day, change is coming. What change is coming, we have no idea. Time will show. We have about 18 days before the elections. It is very important for everyone to come out and vote. And without getting political, we went over a few things today that I believe you needed to hear from me. And there's a lot more pros with the current law than the proposed changes to it under the possible Biden administration. So you don't have to be a rocket scientist or Einstein to figure out which plan will actually save you a lot more money and what needs to be done now in terms of planning for the future. So while this law is still in effect, I strongly encourage you to contact my office today to schedule your strategy session with me to see how I could possibly save you money for 2020, current year, and beyond. We're in the last quarter of the year. It's been a hell of a ride and a hell of a year. A lot of us have been affected mentally. A lot of us have been affected physically. A lot of us have been just really coping with everything that's happening. I'm here to help. I would encourage you to be proactive instead of being reactive. And I would like you to take me on this offer, and by simply calling today, scheduling your free, no obligation consultation strategy session when we'll discuss your particular situation and to see if I can possibly help you improve your tax situation for this year and going forward. This was your favorite tax time guy. I thank you for the time you spent with me today. I would like you to stay safe, healthy, and positive. And for everything else, give me a call, 718-577-2582, and let's see what we could do to make your situation better. Thank you so much, everyone. Have a wonderful day.